I am Andrew Dowse, Portfolio Manager of the Merchant West SCI Balance Plus Fund. Welcome to the quarterly commentary. The fund rose 1.3% in the first quarter of 2023, but underperformed the benchmark peer group return of 4.2%. This was after significantly positive returns over the peer group over the last 2 years. On a sector level, the fund performed poorly in basic materials due to favoring platinum miners over gold miners. Platinum stocks fell sharply with the platinum group metals prices, while gold stocks rallied approximately 35% as recessionary fears took hold. Energy also dragged on the fund, despite the fund picking Exxon, which was up 4.5% in rand terms, as a winner over Sasol, which declined 8.6%. Unfortunately, the falling coal price and poor rail performance by Transnet drove Thungela's share price 29.5% lower, and therefore energy as a sector allocation for the fund. In line with recessionary fears, consumer discretionary stocks largely declined by around 10%. The exception was Richemont, which rose 27%. And enjoyed the prospects of a China reopening following very strong performance recently in its other major regions. The stock has become very expensive, and we believe these earnings are not sustainable. Therefore, we have avoided owning it, but it did cause pain to the fund in the quarter. In consumer staples, the offshore allocation of Anheuser-Busch, InBev, and Bidcorp delivered strong operating results that helped lift their share prices. However, they are also priced fairly aggressively, and the fund does not own these counters. In financials, the fund performed fairly well, but for transaction capital, which declined 61.5%. After persistent weak performance in the SA taxi operations since COVID, the company has decided to revise its credit provisioning approach to better reflect the underlying performance of the book. This was a large once-off knock to the profits of the group that will likely make a loss in this year, but then should stabilize without affecting the other business divisions. We never believed that anything close to 2/3 of the value lay in SA Taxi anyway, and therefore we think the market has overreacted and expect the share price to recover following results. The fund's overweight in Naspers, which rose 16.6%, and its allocation to Microsoft also rose 25.7% in ZAR terms, helped to offset some of the weakness in other sectors. Offshore markets contributed positively to the fund with a weaker rand and broadly higher markets relative to SA. Although some peers have moved more aggressively into offshore allocations, we believe the level of those markets and the level of the rand do not justify moving more capital offshore at present. The fund will likely continue to increase its allocation to offshore through the full period of time when valuations are appropriate. When these valuations are more appealing, the fund will likely grow in its allocation offshore. This fund is best suited for an investor that is seeking to save towards their retirement. The fund has a relatively high exposure to risk assets, predominantly equity exposure, with the fund having nearly 75% invested in equity across both global and domestic markets. The fund is also a Regulation 28 fund, and so is suitable for retirement savings under the current SA legislation.